All right, folks, welcome back. This is the ICT Mentorship Model 13, which is obviously the 2022 free YouTube mentorship that I did on my YouTube channel. This is an amplified YouTube lecture. It's just for this community, and it's specializing in index futures. All right, now before we get into it, I'm going to remind you it's important for you to have already gone through the lessons and lectures I've done on the YouTube channel. Because without that framework or foundation, this is going to feel like it's not clear. Okay, so if you have yet to do it, don't complain about this not being clear, because it's absolutely clear based on the foundation and lessons and examples that was shown in great detail on the YouTube channel for free. All right, so with this model, and whenever we refer to it in this community, we're referring to it as Model 13. So it's the 13th, the last model I'm going to share with this community as foundational that you can use to either run with or build up your own unique model with these ideas as foundation. But the logic for this one is we are looking to trade intraday market structure that targets opposing PD array matrix objectives. So what does that mean? If we're bearish, we're looking for discount arrays. If we're bullish, we're looking for premium arrays. The framework. We use time of day. Now, this is the specific window for Forex. 7 a.m. to 10 a.m., which is in your kill zone, and 8:30 a.m. to 11 a.m. Eastern Time for index futures, which is the AM session index futures morning session. We're monitoring 5 down to 1 minute charts after a liquidity raid occurs and short-term shift in market structure unfolds. Now, notice I've given it a wide range of parameters that could be utilized, because in here, I've taught you price is fractal. I gave them a very specific element of time and rules over there. So it's kind of limited. Even though it's a very good model, it's limited because I'm taking them into a 15-minute chart, and then they have to see a market structure shift after buy side has been taken out, 15-minute or 5. But you can use any time frame. You can use this model on an hourly chart. You can use it on a 30-minute chart. You can use it on any time frame you want. It could be done on a 4-hour chart. Okay, don't think that it's limited to just what I've outlined on YouTube. Everything is fractal. Everything is scalable. But we're monitoring, again, 5-minute down to 1 minute charts after a liquidity rate occurs and short-term shift in market structure unfolds. The setup. If we're bearish, we look for a buy-side liquidity raid. That means buy-side's taken and purged. Okay, if we're bearish, we want to see relative equal highs or a single high taken, ran out. Okay, price quickly jumps up into it. Once it takes that buy side, then we're waiting to see rapid market structure shift below a recent 5 or down to a 1 minute chart low. That's displacement. If the drop after buy side liquidity is purged and creates displacement lower and has a fair value gap, this is ideal. If bullish, we look for a sell side liquidity raid, then rapid market structure shift above a recent 5 down to 1 minute high. If the rally after sell side liquidity is purged, creates displacement higher, and has a fair value gap, this is ideal. Now, before I go any further, obviously for the bearish and bullish scenario, inside that displacement leg, in other words, after stops are rated, then we have a market structure shift respective to the rules here. Ideally, the fair value gap is going to be at or above the equilibrium for bearish and at or below equilibrium for bullish. The entry. If bearish, place a sell limit order at the high of the discount low of the fair value gap on the 5 down to 1 minute chart that formed. What do I mean by that? If we're looking for a sell, the fair value gap is formed by 3 candles. The lower candle that creates the bottom range of the fair value gap, that's the discount low. So you're placing a sell limit order at that high. Now, you can fancy dance it and go above it, but I personally, this is what I'm doing, I'm taking it right at that high, because if the structure is there and the idea is there and the narrative is in play, I want to make sure I'm getting filled, because it might just go 1/4 of a point and then that's it. And if I'm a 1/2 point above with my limit, I'm missing it. Sometimes I've had a 1/4 point above, and even though it printed it, it didn't fill me and runs away. That happens, folks. So to make sure you get a fill, this is the rules. Okay, you won't miss the trade that way. But it also opens you up to more risk. Now, is it going to be that make it or break it type of risk? I don't believe so, because we're on a very, very small time frame chart anyway. So we're talking about 1/4 of a point, maybe 1/2 a point. That's the difference. It's not going to make a big of a deal. If the trade's good, it's good. Stop loss is placed at the low of the premium high of the fair value gap used for the setup. So what am I saying here? We're bearish. We're looking at the candle that creates the highest range of the fair value gap. In other words, it's the first of the 3 candles. The uppermost candle, that low, frames the highest point or the premium high of the fair value gap when we're bearish. We're using that candle's high. That's the stop loss. Okay, not one tick above it, not a full handle above it, right at the high. So we're using the lowest risk parameters that you can use. That way, if the trade's good, you have the maximum in terms of what you could make and the lowest in terms of the risk. If bullish, place a buy limit order at the low of the premium high of the fair value gap on the 5 down to 1 minute chart. When I say that 5 down to 1, it could be forming on the 5-minute chart, or the fair value gap could exist and form on the 4-minute chart, or the 3-minute chart, or the 2-minute chart, or the 1-minute chart. But we're going down. Whichever one from the 5-minute down creates the fair value gap first, that's the one I'm working with. Okay? Stop loss is placed at the high of the discount low of the fair value gap used for the setup. The risk. We use 2% or less, preferably less, per setup of the total equity of the trading account. So if your demo account has $25,000 in it, you're risking 2% of that $25,000 maximum. Ideally 1% or 0.5%. Because these setups form a lot, the frequency of trade can tend to make you want to get punch drunk and go in there and do a lot more with a lot of leverage and hurt yourself. Since you're having frequent setups, you can do less risk, so that way, even if your hit rate is less than 70% or 60%, and if it's just 50%, you'll still be able to do well over time and don't have to have perfection. The mitigating drawdown. That is the same logic I gave in each model, so we're going to use the same reduced risk approach I taught you in each previous model, so there's nothing new that's required here. And what do I mean by that? If you take a trade where you risk 2% and you take a stop out, or you lose the full 2%, your next trade has to be half of the leverage you used in the trade that you lost 2% on. After you make 50% or 1% back in equity, then you can go back to 2%. But if you take another loss on your second trade, you're dropping down with half of that second trade's leverage. And you keep doing that until you can go any lower. And you stay there until you can recoup the 50% of the previous loss. That way you're creating that plateau effect, not a roller coaster up and then down with drawdown. You're seeing it go up in equity, and if you have a loss, okay, it's a small loss, it's maximum on the first one, then you might have another losing trade, but it'll be less. So in theory, it's 2%, 1%, 0.5%, 1/4%, 1/4%, 1/4%, until you obviously make 50% of the previous loss. So it keeps you from having a blowout. PM session setup. We've already covered the morning session, so now we're looking at the afternoon. If bearish, we look for a buy-side liquidity raid on the AM session highs or lunch hour highs. If the drop after buy-side liquidity is purged, creates displacement lower, and has a fair value gap, this is ideal. Yes, that is a typo where it says buy-side liquidity in purged creates. And I'm going to have to deal with this, and you're going to have to deal with it too. So cope, okay? Take a dose of copium and accept the fact that I'm imperfect, I'm human, and I'm going to have to just let that typo exist. I could fix it. I could go in here and fix it and be a hero for you, or I could do therapy and just say, you know what? It's not going to hurt nobody. You know what it should mean. You know what it should say, and I'm making more of it than I should, right? If bullish, we look for a sell side liquidity raid on the AM session lows or lunch hour lows. Okay, what are lunch hour lows? Between 12 o'clock and 1 o'clock New York local time. If there's a swing low or a swing high inside that hour, I'm watching that one. Now, if it's relative equal lows or relative equal highs that were made in the morning session prior to going into lunch at noon, I'm going to be really interested in those getting tagged, not just a lunch hour high or low. Okay, so there's precedence that's established on morning session than that of the hour price action between 12 and 1. There will be times where there is a absence of relative equal highs or relative equal lows in the morning session, and it'll be just a single high. Or it could create relative equal highs in that lunch hour. It's rare, but it can happen. But if there's an absence of relative equal highs or lows in the morning session, I'm going to elect to use the higher low inside the lunch hour. Very simple rules. And if the rally after sell side liquidity is, not in, is purged, creates displacement higher, and has a fair value gap, this is ideal. All right, the entry. If bearish, this is redundant, I know, but this is how it's spelled out for you. Place sell limit order at the high of the discount low of the fair value gap on the 5 down to 1 minute chart, whichever one forms the fair value gap. Stop loss is placed at the low of the premium high of the fair value gap used for the setup. If bullish, place buy limit order at the low of the premium high of the fair value gap on the 5 minute down to 1 minute chart that formed. In other words, wherever the fair value gap forms first, going down from 5 minute to 1, that's the one you're going to use. Stop loss is placed at the high of the discount low of the fair value gap used for the setup. We're coming down the home stretch, folks. Told you, painless. Profit-taking logic. We are looking to take profits at opposing PD arrays. What does that mean? We're looking, if we're bearish, to ride a swing lower intraday to get below equilibrium into a discount. If we're bullish, we're looking for a ride higher in intraday price swings above equilibrium to a premium PD array. The targets on short positions. Any discount PD array at or the closest under equilibrium of the dealing range. Under previous session lows. Under previous day low. Inside the fair value gap or fair value gaps, because it may be multiple ones below equilibrium. Under any of the above suggested PD arrays. Meaning, if there is a fair value gap below previous day's low or previous day's session low, or the same previous session low. There's an additional one I just gave you audibly. It's not in the text here. That way you have multiple targets. You can do partials. Okay, partials is a skill set that you're going to have to acquire, and it's a unique personal thing. There is no hard and fast rule that's going to fit every single one of you. So you have to sit down and figure out which is the lowest hanging fruit for you and be content with that. And experience will be the guide on how you're going to evolve from that. I promise you, you'll come up with your own way of doing it. And even when you get good at it, you'll still not really be fully satisfied because you're going to always see some kind of a experience making a deposit in your understanding of what you're doing and how you navigate and take profits. Again, I've admitted to you openly, that's the weakest part of me as a trader. I'm never content with my exits. And you've seen them, in the layman's eyes, it looks phenomenal. But to me, for doing this 30 years, I'm not satisfied with it. So I'm always working towards trying to improve that. Sticking to the rules, but I'm always looking for ways that I can find a secret shortcut, if you will, to get to a better way of being consistently precision-oriented targets that deliver more accurately than I already have. And I might not find it. It might not exist for me. You might find it for you. So aim for it. The targets on long positions. Any premium PD array at or the closest above equilibrium of the dealing range. Above previous session highs. That means if we're trading, obviously, in the PM session, we're looking at the AM session. If we're looking at the AM session, we're looking at yesterday's PM session. So I wasn't making that clear earlier, but now I just did. Above previous day's highs. Inside the fair value gap or fair value gaps above any of the above suggested PD arrays. So what we're looking for is the market reaching up into extreme premium levels, where there's a fair value gap, where there is an order block, where there is fair value gaps that may exist beyond the scope of the session you're trading, the previous day's session, and or the previous day's high. So that way you're really getting there where buy side is, and you may break the dealing range and have to look at the previous day or even the day behind that, depending on how strong the market's moving. Where to anticipate trades. AM session. At 8:30 a.m. Eastern Time, news or embargo lifts when high or medium impact news is released. Obviously, you know that one. I was shared on the YouTube channel model. At 9:30 a.m. Eastern Time, when U.S. equities markets open. That was shared on the YouTube channel as well. At 10 a.m. Eastern Time, after the first 30 minutes, sentiment is established. Think Judas swing. Okay, sometimes it'll form there. In other words, what I'm saying is, if you're looking for the setup, start looking at it around 8:30. It can form early. Then at 9:30, if it hasn't formed yet, if it hasn't formed at the 9:30 hour with the immediate Judas swing at 10 o'clock, that time window, then start hunting it again. In other words, you're continuously looking at the clock and you're gauging, has it formed yet? Has it formed yet? Each one you're going through expecting it to form. At 10:30 a.m. Eastern Time, after the first 60 minutes, opening range is established. So you have that first hour's trading. That's going to be influential throughout the rest of the day and potentially the rest of the week. Hint, hint. Nudge, nudge. There's something for you to mine right there. So at 10:30, if it hasn't formed yet, that's kind of like the last opportunity for it until we get to 11 a.m. Eastern Standard Time. On days of the week that offer conditions for market reversals, that would be Thursday and Friday. So in other words, I'm not really excited about taking 11 o'clock setups unless it's Thursday, Friday, and we might be having TGIF conditions where it comes back into the weekly range. Or we're looking at a longer term market reversal. It's gone up to a shorting opportunity on a higher time frame, and long term higher time frame we're looking to go lower. I could use that 11 o'clock to get in sync with what is typically referred to in our group as the London close time. So there's a lot of factors that treat that 11 o'clock as a market reversal. So if it's setting up at 11 o'clock, chances are, not all the time, but chances are, if it's day of the week, Thursday or Friday, that could be a market reversal profile unfolding and then leading into TGIF. PM session. At 1:30 Eastern Time, when New York lunch volume completes and volatility returns intraday. That was shared on the YouTube channel. At 2 o'clock Eastern Time, when PM trends start to unfold and potential AM stops are purged. Could be the lunch hour stops as well. At 2:30 p.m. Eastern Time, when the final 2 hours of trading begins. That's speaking of the day session for New York trading. At 3 p.m. Eastern Time, final hour of day session trading ends for New York. And 3:30 Eastern Time, market on close conditions begin. These last two, if you are a very, very proficient scalper and you're working with 30-second and 1-minute charts, you can find this setup just about every single day in the last hour of trading. It's going to demand high level of precision and nimbleness that most of you probably don't have yet, but it's something you can mine and study. Okay, I do a lot of really ultra short-term trading in that last hour of trading on the index futures. And literally, there's a lot of wonderful explosive price action moves that occur in that last hour of trading, which I've also hinted at on the YouTube channel. But here is these elements that work towards breaking down your day. You're not going to get a setup, obviously, every single one of these. You're working through the day, saying, okay, at 8:30 in the morning, I'm looking for it to set up. If it doesn't set up, I'm waiting for 9:30. And at 9:30, I'm waiting for it to set up. It doesn't, I'm waiting until 10 o'clock. So it gives me that what? Patience. I'm waiting for the algorithm to key off of these times. These times are based on what I'm showing you here. Now, with everything else I've taught you with algorithmic theory, these are the times that are highly specific to index futures and what it's leaning on, okay, as to why or what's the catalyst behind it. Not invitations to take a trade every single time every one of these time windows begin, okay? It's not like you're going to get, 5 setups in the morning and then 5 setups in the afternoon. Don't think of it like that. Think of it as that you're looking for that one good setup that's forming for each session, respectively, AM or PM. But you're looking for that one choice setup that is in alignment with your bias. It obviously lines up with the narrative of the day you're looking for inside the weekly range profile that you've been studying. And everything just makes sense for it to be running to a specific price level. It's one-sided. It's not easy to make this setup go the other direction in terms of analysis. So you have one-sidedness. That's high probability. Use these elements of time for that to make it a little bit better for you for selecting your setups. And I think that's going to be it, folks. And obviously, it doesn't scratch the itch if you've never really studied the model or if you've never gone through the 41 videos on the YouTube channel with the 2022 free mentorship. But I promise you, if you haven't done it, if you go through that and you come back to this here opens up a whole different perspective of that model. Hopefully you found this insightful. Until next time, be safe.